All right. Thank you, everyone, for joining us. We thought it was a great time to do another meeting and talk about a lot of things that we're hearing that are worrying a lot of people. So it's a good time to check in. Also, some housekeeping items before we jump into that. I know everyone has been getting notices from us as well as from TD Ameritrade about the upcoming transition. As a reminder, TD did get purchased by Schwab. They're expecting the complete turnover here on Labor Day, but look for emails from us because they're going to be coming with details of things you need to watch for. Don't sign the negative consent letter. That means your account needs to transfer somewhere else. Everything is set up and is supposed to be very seamless moving over, but there are a couple important dates. So watch for emails from us that are going to inform you of those. Some are coming at the end of this month. You'll be able to access and log in and be prepared through the Schwab site instead of the advisor site with TD, as well as you're going to get a packet. And unfortunately, my understanding is you're going to get one packet per account. So if you have more than one account, you have 5 accounts, you're going to get 5 welcome kits that will come into you. So look at those. Let us know if you have questions, but as we've been told and promised by TD and Schwab, this should be a very seamless transaction for you. We might have a few things that need to be taken care of, but we'll keep you posted. Blue Leaf, that's our performance software that you all use. It is supposed to keep all of the history from your prior accounts, so we don't lose like we did when we moved from Cambridge to TD. So that should all come over, but I don't know how quickly. So some of this stuff, be patient with us. It's all systems talking to each other. Some of it may take a little longer than others. Also, remember, if you have questions during this call, raise your hand, we'll unmute you, or you can chat, whatever works best. But I think that's it, Dave. I guess I'll turn it over to you.
You know, I'm going to add one little quick thing that because you've run into this too, and I have as well, to help people understand what Schwab is. You know, I like Schwab, or I don't like Schwab, or I like TD, or I don't like TD. Number one, obviously we have no choice, or we do, I guess we could go clear to another place, but TD is going away. It's being absorbed by Schwab. But that comment usually comes from, I didn't like my advisor that was with Schwab. I like you guys, or I like, and I get the association, but understand there's not anything really to like or not like about a custodian. They just hold the assets. That's what they do. They don't make decisions on your behalf. They really don't. And I think it's important to understand too, that almost everything coming over is there's just little change. There's no cost to trade. Nothing's really going to affect our clients. I really don't think so. Not yet. Okay. Yeah. Is this good? Never. Not with one and number 2 merging together. That's never good in any industry. It's just not. And I'm not going to make the case that I'm positive your costs will always keep coming down in the industry. I'm not, but there still are competitors out there. So I'm optimistic that they're not going to be coming up anytime soon. And if they do come up, I think technology is going to push them right back down. Some of the things that we often take for granted is that many of our trades are traded in a half a penny. I'm not joking. It's you can buy thousands of dollars, tens of thousands of dollars worth of securities and not only not move the market, but not even have to pay a 1 penny spread in some securities. And that is way different from when Trust Choice was here in Boise, trading at $1.25 spread between the bid and the ask, and forget about the $150 to buy the darn thing it cost or sell it. So these things have all gotten so cheap and so easy and so fast. It really shows up in better returns for everybody. So again, bear with us on any little glitches. We think they're going to be minimal, and that's all I'm going to add to it. Just you don't have to do anything. Just don't do anything. You don't. And have
one
to
more
do
thing
anything.
I did forget to say, and it's super important. Petso Financial did not sell. We are still Petso Financial. The only thing is we had no choice. We had to transition because we were with TD, and we're not going to go through the nightmare before that we did. So we're just going to let this happen. It is, but we didn't sell. Whoever you work with here at Petso Financial, you will still continue to work with. Our relationship's exactly the same with you. It's nothing different. It's just where your money is held because we don't hold money at Petso. Okay?
Right on.
Perfect. All right. I'll be quiet. It's all you.
All right. As soon as I get my screen back, I blew it up. All right. There we go. Good. All right. So it's a catchy title. Okay, right. You know, are we scared or should you be scared? All of those things. Well, that's what really triggered this whole thought process, is that we're in the slower time of year. There's not much going on, but one, we haven't talked in a while. Two, I keep hearing about digital currencies, and then I hear about buying gold, and I hear about these things. I'm thinking, you know, that's just flowing around out there. And I know fear sells. It's louder today than it was last year. It's multiples louder now than it was 5 and 10 years ago. And yet human beings can't really keep up with this pace of, yeah, we're all going to die, because it comes from so many different places. But it is important to understand there's a lot of bad stuff going on out there. This is not all good. And I totally appreciate and understand that there is a real lack of leadership in the world, that freedom seems to be tampered down. And that's not just, oh, everybody's becoming socialist. There's a lot of dictators running amok out there. We were just on a call with Vanguard and talking about emerging markets. And I'm like, how can you invest there? It's dictatorships, it's corruption. Why would I ever trust the Chinese? How can you? They arrest Jack Ma and then just, you know, hold him hostage. And now he pops back up, but he doesn't own the company anymore. The Chinese government does. I can't invest in that environment. And so it leads me back to some of the fundamental things. And I just thought it would be a good message, both for me and our team, but also to talk with you about some of the things that I keep seeing out there. And I don't want to sit here and poo-poo digital currency. It's just this thing, but I know where the fear comes from. Of course, we're becoming digital. Who walks around and goes to the grocery store and flips out $160 anymore? They don't. It's the debit card, it's credit card, it's whatever it is. We're all digital. And I want the 3% cash back, or 2% cash back, and 3% points on my airlines, whatever it is. We all want that. It's all digital. So it's really not the digital currency thing. It's the lack of trust in our government that is now being investigated, the FBI and the Justice Department, and this goes on and on and on. It's hard. It's hard to trust that this is not that it really isn't a two-tier justice system. And it throws off our thinking that if this digital currency comes, the government's just going to take my money. They're two different things. And we shouldn't be thinking about that in terms of, that's why I'm going to decide that it matters how many iPhones Apple's going to sell next quarter. It doesn't. It doesn't matter. Innovation, all those things, they continue on. All those things are concerns, but they shouldn't change the way we think about investing at all. And it kind of got me thinking about the rights and the wrongs, the mistakes you make, the positives, and pulling back and hearing John Templeton in my ears, hearing Warren Buffett and talking about they don't have a market outlook. Well, yesterday we were talking with JP Morgan, and of course they say, oh, well, you want to hear our market outlook? No, I don't. You guys were wrong by huge amounts last year. You're probably wrong by less than that, because it's really hard to be as bad as you were 2 years in a row. And then today it's Vanguard, and they're like, our outlook, and it was literally, this was hysterical to me, that they think that that international markets are going to be 7.83. I kid you not, per year. And that's better than the 5.9 or 2 or something like that the US is going to do. And I just go, why are we predicting? It's just how much of a magnitude you're going to be wrong. We can't. And so when we think about these things, it's like, we don't have to be predicting. And I know that's contrary to human nature. So contrary. I need to predict. Why? And when we have the humility to know you can't predict, number one. Number two, all kinds of weird stuff's going to happen that it's not on anybody's radar screen that's actually going to take us out or take us down. And markets always bounce back. And so what we have to do is from time to time stop and say, what is important? Is it the magician? Hey, watch this over here, and the real trick's occurring over here? We understand that. But if we're watching prices move around in the market, then we start thinking of the market as monolithic, and it's not. It's not monolithic at all. The market is comprised of multiple companies. I'm just going to give a couple examples, and then I'm going to actually show you some of the portfolio things that we try to look at. But when you think about what's going on with the market, what Wall Street knew is that value stocks were the ones to be in at the beginning of 23. Now, why did they know that? Because you could look in hindsight and go, oh, 22 was really good for value stocks for the first time in like 30 years. Okay, good. So we think that trend's going to continue because tech stocks are way overpriced, way overvalued, blah, blah, blah. So what's occurred this year? The exact opposite of what Wall Street knew was going to occur. And these people are paid massive amounts of money to like literally be wrong more than a coin flip. And I'm not just here to make fun of them, but it brings us back to the why are we making predictions? What does it matter if you're drawing income from a portfolio, what the S&P is going to do this year? Let's just pretend for a second you could actually get that right. What does that change about your portfolio that's designed to have cost of living adjusted income all the days of your life, no matter how long you live? What does that have to do with it? Absolutely nothing. And it acts again like you should own exactly 5% Apple, 4.2% Google, because that's the composition of the S&P. Google pays no dividend, but maybe you want income okay. It doesn't make any sense. It has nothing to do with it. Zero. And when you're thinking about, for example, let's use the energy sector, because that's something that pays really good dividends, and a lot of you are going to own a lot of energy, okay? Well, they have everything from a deep sea driller like Transocean or Apache, which is on land, drilling for oil. So if the price of a barrel of oil goes up $1 or down $1 or whatever, their stocks are all over the place. And you also have stuff like Kinder Morgan. Many of you own that. Why? Because it pays a 7% dividend. And they seem to raise it about every year. Sounds pretty good. What does it have to do with drilling for oil? Almost nothing. It's a pipeline company. Both are considered stocks in the energy sector, part of the S&P 500. And they're not at all similar. But we think about when we talk, how's the market doing? What do you think about the market? Wrong questions. What do you think about my ability to draw 5% income for the rest of my life, cost of living adjusted, and never run out? I think your chances today are better than they've been in 15 years. Now, how can you say that? JoJo's in charge. We have no leadership. He stumbled across the tarmac again the other day. We've got China. We've got Taiwan problems. I got it. Because interest rates are higher now, we can actually own bonds for the first time in 15 years. And you see that, and we are. So in other words, as far as predictions, there's no prediction in that. I didn't predict interest rates would go up 5 percentage points instead of the 0.75 that the Fed told you it would. See, the Fed controls this, and they were wrong by a magnitude that is ridiculous. You couldn't make up how wrong they have been. You can't even be like, no, nobody's going to watch that movie. It's so stupid and unbelievable that the people could be this wrong. Well, they are, because predicting is wrong. But reacting to what happens, now that interest rates are higher, oh, so we can get 5% in fixed income. Now we can own it. And there's some other dislocations that we can use, right? It's not predicting that, okay, that preferred stocks and publicly traded REIT thing that we use is going to go to the moon in the next 6 months. No, it just looks like the valuations are incredibly good. Incredibly good. So we react to the market and use it. We don't have to predict it. And the world is full of these predictions. We all do it. I ask a question. Everybody asks a question. What do you think of the market? What do you think? What do you think? Okay. Picking on JP Morgan. They were 2 days ago. Do you want to you want an outlook. Well, the young man is he's one of the best wholesalers we have. Super guy. Would never do that. But they had a strategist on there because he knows exactly how we feel about it, because it's like, no, I don't want your predictions. You guys were wrong by a ridiculous magnitude last year. You're going to be wrong by some magnitude this year. And 51% of Wall Street, factually, over the past 20 years, is wrong. So we've decided we are going to go with blind monkeys throwing darts. That's what we're going to do for our predictions in the future. Of course, we're not going to do that because we don't have to predict. We react. If something becomes a very good value, we look at it. Often it's wrong. But one of the things that happens is that I come back to what Warren Buffett has been talking about recently. He's talking about it for 70 years. But to me, it's just one of those things. It's like an aha moment. It's such wisdom that just comes out. You just go, wow, that's exactly it. People are trying to predict. And Warren Buffett for 70 years says, and he just said this at the last, whatever, the Omaha thing that they do every year, annual meeting, said, I have about 10 investment decisions. He said 12, and but 2 of them were personnel decisions that accounted for virtually the entire rate of return of the portfolio. And I was just aghast. 10 investment decisions from Warren Buffett, and the rest are mediocre at best. That's a quote from Warren Buffett. Like, wow, that's incredibly profound when you think about it. Peter Lynch said it, that you have to have some 10 baggers, meaning some of the things you own, the stocks you own, have to go up 10-fold plus in your career. You have to have some of those. So I'm thinking about this. Apple is up 40-fold plus since the iPhone came out. Not since Steve Jobs came back the second time and they had no money, they were almost out of business. No, you had the greatest product in your hands. And it was different. It was stunningly different. Not because it's just pretty. It operated completely different than the Crackberry I had in my pocket. It was something to fall in love with. 40-fold. You don't have to have a lot of 40-folds. You don't have to have a lot of Apples, a lot of Googles. Most of you have sold off more Apple over the years. We did it for you. Than you ever put in the original batch, and it's the largest holding you have. Because it just keeps going. But you have to own it. You can't trade it. You can't be worried about, well, what about that Beyond Meat thing that I bought? That's only in my portfolio. It used to be. Now it's a tax loss on there because I thought that was a good idea. Not a good idea. No, there's plenty of bad ideas. Plenty of bad ideas. But they all get covered up. And so when we look at the market year we're having here, where you hear the CNBC talking heads that are always wrong, but boy, are they certain about their uncertainty, right? They know what's happening. And so they're telling you now that the market is really only driven by 7 stocks, or is it 6, or is it 8? I don't know. But it takes all of those stocks and the huge increases they've had because they're giant companies and it's a cap weighted index and blah, 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 as to tell you why the market really isn't as good as the big gains that you have in your portfolio would think it was, or that the world isn't really about to implode. All of these things are not predictable. All I know is that great companies continue to multiply wealth, and they are few and far between. And if Warren Buffett gets 10, the greatest investor of our time, over a 70-year period of time, how many are we going to get? And how many do we think we need? And so when we look at our portfolio and go, that thing over there, why do we own that thing over there? It's the stupidest thing I've ever seen. Expect that to happen more. Because it is rare to find an investment that just rolls. It seems easy when it's on your portfolio and you go, man, I cannot believe the gains we have in Apple or Google, depending on if you're a growth investor. If you're an income investor, you probably don't have Google in your portfolio because they don't pay a dividend. Look at what Microsoft's done the last 10 years, the last 30 years, 40 years. But there was a time it wasn't a great company. They reinvented themselves and boomed. We don't have to predict. We don't have to have a market forecast. Warren Buffett says it this way: we have never had a prediction of what the market will do, and we never will. Okay, if Warren Buffett doesn't have to have a market prediction, doesn't make one, never even contemplates it or thinks about it, why am I? Why am I? And the answer is we shouldn't. Once again, we're looking at the market and not thinking about what it is our objective is. If our objective is income, don't I want the Kinder Morgans of the world? Well, I don't. If the oil is going to go to $90 a barrel, I would rather have an offshore oil driller that's barely staying in business, but super levered to it, but has nothing to do with my portfolio and what my objective is. I want Pioneer Resources, a 10% plus dividend yield. I want the Kinder Morgans. I want ETFs of those things so that it pours income into my portfolio. If you're a growth investor, different ballgame altogether. I don't know what the market's going to do. I have no reason to believe that the market is going to go up or down. I've been astounded by its consistent rise this year with all the problems there are in the world. But this is the point of it. We didn't come into this year and go, I think the market's going to be terrible, and make a prediction and leave the market. So what happens when everybody's baffled by how good something is? You participate. And it's given us tremendous opportunities to say, wow, now with interest rates at 5% plus, in some areas over 7% in some sectors, maybe we can take some of the profits of those companies and buy some more of that and increase the yield of the portfolio, and also increase the safety, if you will, lower the volatility, lower the temperature of the portfolio. And I'm back to this. That's why I think it is an easier time than in the last 15 years to say, I believe we can deliver 5% cost of living adjusted income all the days of your life, no matter how long you live. That is different. And I'm telling you, I already know you don't feel that because you're a human being. We feel awful. And I don't care if you're a Democrat or Republican, you're far left, you're far right, you're somewhere in the middle. Everybody, poll after poll after poll, is just going, this ain't right. This is wrong. The world is upside down. It is. It doesn't affect your investing. Shouldn't. It shouldn't. We want to react. That doesn't mean you react to what was good and then shift all your money to what was good last year, because now the prices are high. But it does mean when interest rates come up, we can own bonds. We couldn't own them before. Wall Street tells you the opposite all the time. And we're trying to predict. And that, I think, is, again, taking our eye off the ball. Now, I want to show you a couple of quick charts, because let me put this in the context first, because this is where it came from, okay? It came from this. You have to understand that some people would have maybe come in and had money for the first time, big money anyway, for the first time in 2020 or 2021, somewhere in there, right? Or even earlier. But the point is, maybe you ran a business. Well, a really close friend of ours did, and sold, super successful woman, sold it for a bunch of money. She's actually who introduced my wife and I. And so this is a close friend of ours. Brings in the stack of money now, okay? Terrified. I don't really like stocks. I don't really like this. And what do you think about the market? All those normal questions. It's going to be okay. And it was, because it was 2021 and things were going fine. They were going swimmingly. But what happened in 22? And now it's all the time. I can't lose this much. I can't lose this much. I can't lose it. It's all going to go away. And so what I did, and she came in, good on her. And I just had an epiphany. I said, I'm going to write down the 10, 8, whatever it was, dividend stocks that she had. And go back and find the dividend 12 months ago. And what it is today. And she got it. What does she want? Cost of living adjusted income, all the days of her life that she can't outlive. The portfolio goes down 20% from its highs, meaning the stuff in there, most of those stocks, some are down 30, some are down 10. You get it, it's an average. But all of them but one increase the income, which is the only thing that matters. The only thing. So let's look at a couple of those components because you'll recognize these names in your portfolios too, right? Okay, so this is Honeywell. They're, multinational, all over the world, all kinds of different things. And what you see here is the blue line is their stock price. And there's the dividends above. 2 dividend increases. It's kind of sort of what they do every year. And you'll also notice that even though the price is down, you'll also notice that this runs through the end of last year. Why? Because we don't want to show the line all the way up again. It just doesn't, which it is. But that's what stocks do. They go down. And of course, if we sell down here, that's silly and raw emotion, but the income is going up. Let's go to another one, just as an example. Okay. Okay, this is Microsoft. So Microsoft, that's a growth company. Yeah, well, sometimes it grows, sometimes it shrinks, but it always does really grow because the value of the enterprise keeps going higher and they make more money. So they do what? They raise the dividend every single year. Next one. Simon Property Group. Now, nobody can make money on shopping malls. We all know they're see-through. Why would you own a company like Simon Property that owns shopping malls? Because they pay a nice, big, giant dividend. Stock price down, which it isn't anymore. But the other thing is when you look at this to kind of give the example, sometimes if you're searching for income, you wouldn't find Simon Property in a growth portfolio. But Simon Property is paid its dividend through the pandemic. The value of the underlying properties is massive. If the Boise Town Square Mall, as an example, is not able to operate profitably and grow its asset as a regional shopping mall, do you really think it'll stay a regional shopping mall? Because I don't. I think it'll be a data center or it'll be big giant condos or completely dynamic like the Village is in Meridian, where there's cool little shops and things like that. I don't know what it's going to be, but they're not going to sit around losing money on valuable real estate. They'll do something different. That's the point. So let's go on and look like one more here. And Texas Instruments, same thing, 2 dividend increases. Texas Instruments, big giant blue chip company, paying a nice dividend and most importantly doing what? Raising it every single year. Now, some of them don't. And that's our next one here. They just kind of cruise along and are paying a massive dividend. And you probably won't own a Dow Chemical forever. They seem to kind of be one of those that we would do what's called a swing trade. Buy it at 50, sell it at 60, some multiple years later. But in the meantime, you're pocketing a nice dividend. Unless something happens, positive or negative, to change that dynamic. And positive could be they find a new growth engine. But, dirty chemicals, and that's not a statement, other we need them. But that's not really a growth business. It's just not much of a growth business. They make money, pay a lot out in dividends. We like that. So there's different reasons for different companies, okay? But the point here is price is what everybody asks about. Value is what you receive, which is an increasing dividend. And that's what we're focused on. And hopefully, I know you're human, but it just takes our eyes to the bottom line. And we don't want to live there. We want to live with an understanding of what it is we're trying to do. And that is increase income every year faster than the rate of inflation. Okay. Now, I want to go back to how wrong everybody is all of the time. This is JP Morgan's slide. JP Morgan, approximately 13 months ago, ran this slide to a fairly large group we had over at Hillcrest. And that was this slide telling us that the average PE ratio was 16.5. Apparently now it's 16.8. Okay, it's 16.5. And the market was overpriced because of that. And therefore, their prediction was a 3,200 S&P. Well, that's only 1,000 points or 35% off. And so JP Morgan wanted to ask us 2 days ago if we wanted their outlook. This is a chart of how human beings think. This is a chart that says the average, if the market is trading for a higher price to earnings ratio than its average, it should be sold. But if you look at this chart over a 25-year period, you will find that there are approximately 7 trading days where it actually was on the average. In other words, the average meant something. Because the rest of the time, it doesn't mean anything. But we think linear. We can't think out of the box. We have to make predictions, even though we're wildly wrong and nobody ever stops and goes, you know what? This doesn't make any sense. We sit around every year and make predictions and we're never right. Almost never right. Why do we do this? I don't know. But then in Vanguard, even after introducing that, we had a nice conversation with them, and they're good people too. They really are, truly are. And that was today, right before this call. They do the same thing. I mentioned it earlier. They're predicting to the 100th percentile what the international markets will average over the next 10 years. And nobody apparently sits around the table and goes, why would we embarrass ourselves with a 0.83? 7.83? What do you think it'll be somewhere? I don't know, positive. That's pretty good. It's crazy how we get caught in this game that we can do numerology, that we can make predictions off of numbers. And we can't, because the world is dynamic. So let me tell you what we're thinking. Okay, here's another way of looking at the same thing. You see how the gray is way apart from what the average is? Is it? Why? It's silly. The valuations are all over the place. Always. And they don't just come back to this return to the mean. So I've been asking this question on a broader scale too of us. What is it we're doing? When we react to the markets, what are we thinking? And I came into this world of investing as a value guy, a disciple of John Templeton, if you will. What worked last year won't work this year, and reverse it. And I'm thinking, for the past 30 years, some of that stuff doesn't really work. And that's not to say, here's what I actually believe about John Templeton. He would have changed, just like Warren Buffett does, because all great investors, when presented with new facts, change. That's not true of Wall Street typically. Remember, they have 60% stocks, 40% bond portfolio. That's how you do this when you get into retirement, even when interest rates are 1 or 2%. And I'm like, that won't work. No, it's the way it is. This is the way the computers tell us to do things. It's crazy. So I'm asking ourselves all the time, if we can get the returns we need without the risk. In other words, it's called a risk assessment, a risk judgment of how much risk you're taking on. If I can get, say, bonds, high yield bonds that have equity-like returns, we'll do it all day long. Right? Even in a growth portfolio, because it's less risk, same returns. That's the thought process. Okay, now you take that across a broad range of things. Now we can own bonds. It's okay. What kind? Well, that depends, and I don't want to get too far in the weeds. Some short, some longer, some preferred securities, all of those things, okay? All fit in, but it's not monolithic either. Everything has a piece and a part that fits in to the portfolio. But what we're thinking now is, well, we should be diversifying into small cap and mid cap and large and growth and value. And I look at it and I go, but the 1-year returns and the 3-year returns and the 7-year returns and the 11 and the 12 and the 17 and all the way up to 30 say growth over value. They win in every one. It's the United States over the rest of the world. I don't care how cheap Europe is. It ought to be. They don't invent anything. It's a great place to go visit, trip over the cobblestones, and take some photos, but they don't do anything. Emerging markets, they're growing in middle class. No, they're not anymore. So we change directions. We don't get caught in, that's cheap relative to the historic valuations. Well, it ought to be, because they don't do anything. Now, it doesn't mean you won't have some high dividend paying stocks in Europe. And if managers find things, ASML is a phenomenal company in the Netherlands, an incredible growth company. And if your mutual funds, ETFs want to own it, I believe they ought to. But to make an allocation to places that aren't growing, or because you need growth and value and so on and so forth. And if you need dividends, that leads us to value. But I want growing dividends. And then we'll have some high yielders so you have the income you need, but we're still growing. Because that's what's won. Like forever. Technology over dirty industries. Don't own airlines. Don't own automobiles. Why? They don't ever do any good. I don't want to buy an airline because this time, I think United might survive the third bankruptcy. I mean, it's been bankrupt twice in my lifetime, my career. It's twice. Delta, American, doesn't even include Eastern or Trump Airline. They're all gone. I don't want to own those industries because they're value. I don't want to own them. I want to own things that are growing. I don't have to have all my money in Google, but I want the Apple that keeps having high cash flow and kicks off some in the form of a dividend. And I want ETFs of those kinds of companies. Some I don't know. I don't have to research. I want to own that. I want mutual fund managers that find growth of income, because that's the safest place to be, even in an income portfolio. And all you see, all these, like the Wall Street Journal the other day, was the older people are all investing like 30-year-olds. Like it's really stupid to own stocks. You know what? It's not stupid. This was a front page article last week. I know nobody sees it because it was like the 4th of July week. But the point is, this is a front page on Thursday, talking about the crazy 70 and 80-year-olds out there. Well, perhaps after being 70 or 80 years in the markets, they learn a thing or two, that stocks always outperform bonds. And I'm talking income over long periods of time. Always. It's not even close. It's not even close. It's not even on the same planet. It's not even close. It is so far off. Stocks have paid out 9% increase in the S&P 500 over the last 50 years. 9%. Inflation's 3%. Bonds are like 0 because they don't go up with inflation. My point being, you see lots and lots of things of short-term volatility. We want to think out long-term and what our objective is and ignore the noise. The world is heavy with worries. I got a ton of them on my back, right? Not just because of money. I don't mean that. Because everybody's worried about stuff. I worry about my grandkids. I worry about the safety of this, the freedom of the world. I worry about all those. Take this thing off of this weight of worrying about, should I be buying gold? Should I be buying this? Should I be buying? No, stop. We buy things that have yields. We put them away. We enjoy the income and we don't worry. Because that makes us do the wrong thing. Okay. I've gone on too long. I know it. But I want to tell you also that there's a phenomenal article out there, very well balanced. And we have a link if you want it. It's in Imprimis. It's an article about climate change. But for me, it wasn't just about climate change and the economics of it. And it's not right or left. So if you're looking for some kind of proof of left or right, it's not. It's a very balanced one. But the point of this too is how we dialogue about everything. Instead of dialoguing and solving problems, Wall Street dialogues, makes predictions, and we're running the wrong direction. We're running the wrong direction. Not everything should be politics. Almost nothing should be. But that's the world we're in right now. It may not be the world of tomorrow, and I hope not. But it is right now, and it's loud, and we just need to just dial it back a little bit. Anyway, let us know. And Don and Trudy, if you're on this call, I don't know that you are. thank you so much for sending that over. And we have that link. All you have to do is call the office, shoot us an email. We'll link it back and send it to you. Okay. With that, I better just shut up and take a question or two. And because I've run on a long time.
Yeah, you have quite a few questions too, so that's good.
Okay.
All right, first one, you ready? Regional banks, what's the potential impact?
Good question. That is we're going to find out here over the next couple of weeks. I think not find out everything or find out the future, but we're going to find out a lot on the earnings calls from them. Big banks for this week, then the regionals will start up over the next couple of weeks, and we will get a better feel for what their earnings picture is. Clearly, it's not just a finger in the dike. I think that this is fundamentally a problem, and I worry about the banking structure of the United States long term, where the big just get bigger and we turn into Europe and we don't have the community banks that lend to small business. That's my concern, where this comes from. From a safety perspective, the whole economy going down, not remotely like 2008, and already the feds come in and said that is not happening. Now you can say that was because it was Silicon Valley and not West Texas. Okay. That very likely is true. And they are big Democratic donors, and that's who's in power right now. But at the same time, it just it's not going to be contagion. It won't be. So I don't worry about it. But I don't invest there either. Banks are hard. They're hard. Okay.
So you kind of really went into detail on this. So I think you covered it, unless there's anything more you want to add. If you can't predict or plan, how do you know when to retire?
Oh, good. No, that's easy. Okay. When the 5% is enough, then you can. When it's not, then you can't. And so if you need 10,000 and let's say Social Security is 5 or pensions, whatever, and you need another 5 and you've got 1.2, 1.3, and you got another 100,200 for a cushion, right? I don't want you to come in like, what? No, then don't. You really should come in like at 4%, and the rest is mad money. If the market's great, then you go ahead and take a little extra out, and then take a wild, crazy trip or go buy another car. All of those things are easier depending on the risk level you want. But that's the easy answer when you have enough capital to generate the income you need. Cost of living adjusted.
What concerns do you have in regards to potential effects of AI in the investment arena?
I think that AI is going to be just like everything else technology, but maybe more dangerous, right? It's scary. It's scary, and it's also probably going to cure cancer. And it's probably going to make us all live a lot longer than we thought, and healthier. It's probably going to get rid of Alzheimer's, which is what like all of us worry about, and all those things. I think it's going to drive costs down in a lot of different areas, but it's going to be weird and it could be dangerous. And obviously, we've got enough bad guys in the world that they're not going to put any barriers around it. You know, you really think Putin's going to do that? You think Xi is going? Yeah, I'm kind of worried about our moral compass here. They're not. They're evil people, and they want to dominate the world. So AI will help them build better armies. So I worry about that. And I don't really know. Nobody knows.
How is ESG affecting large cap stocks?
It's not affecting it. I think ESG is way overstated. It's and it's being found out to be a phony way to invest because people measure ESG differently and different companies. It's not like I think we ought to do this and you think we ought to do something else. It's not just that. It's one company can rank really good ESG according to, I don't know, the Greenie Digest, and it can rate really terrible in some other environmental place. It doesn't make sense. And so people are finding it's really crazy. And the idea that business functions well at all, being some kind of social boundaries for us, is like pretending that the government is here to help you when they come and knock on your door. They're not. They're an impediment to everything. It's like sand in an engine. And I don't care what your politics are. There is no economist in the world who goes, really, I think that the best thing is bigger government to run more efficient industries. It's not. It's never worked. It won't work. And that's the same thing with ESG. They should not be focusing on that at all. And I'm glad to see the swing the other direction. And I think it's hopefully going to go away.
All right, what about the effect of the BRIC countries, Brazil, Russia, India, and China moving to gold-backed currency? How will that affect the dollar and then the stock market?
Well, they're not, they won't. And so it's all made up. Okay, it just is. It's not, I'm sorry that all these things are crazy. Brazil, Russia, you say India, and I get it. China and Iran are going to have their own currency, and people are going to go, wow, I just don't know what we're going to do. I mean, this is like the United States going, I think it's a better idea we just kind of let the mafia run things. You know, let's let the criminals do it, because that works well. They all end up shooting each other. They all end up killing each other. Nobody's going to trust them. And so I just go, well, I'm sorry. And I don't mean to put people down for this. I just don't, it doesn't make any sense to me. And if it doesn't make sense, I want to think through in a common sense way and say, it just doesn't make any sense. I'm not being Pollyannish. I'm just saying it's not going to happen, because nobody trusts these. They're terrorists. They're horrible people. Nobody trusts them. Imagine Europe going, I really like that idea because Putin's really been a great guy. Let's do that. They're not.
Who do you listen to or consider when making decisions or modifications?
Wow, that's a big question. Okay, it's, I listen to my head, of course, but we all have to think about it. But we do have some inputs that we do listen to. First Trust has some pretty darn good economic data. And Brian Westbury is their chief economist, but they've got a number of them that are very good. I listen to that, but I also, it's not that Warren Buffett's making predictions. It's also, as I said before, he's not. And so the inputs of what's going on in the world are great, but that question also hides behind it saying, when you make changes because you're predicting, we're not. Oftentimes those changes are because we're reacting. We can now own bonds again. Okay, that adds more stability to a portfolio that's objective is cost of living, adjusted income all the days of your life, right? Okay, so you get that. So we can do that now, so we will add. What areas do we go into? Gosh, there's, this is just from experience. There's multitudes of things out there, and we look for the ones that have the best bargains relative to the risk that you're taking on them. And then when we see things like Pioneer Resources trading at low levels, we go, that's a 10% dividend. Get some in there, good. If we get the bargain. If we don't get the bargain, we don't buy. But that's how maybe overall, it's more of a thinking of just staying in touch with what's going on and reacting to what the world gives us is a better way of saying it.
Good. That looks like the last question. If I missed anybody, please let me know, but I think we got y'all.
Perfect. And I obviously got a little wound up today, so thank you. I appreciate it, and I didn't mean to go quite as long, but I see most people stayed with us, and I do appreciate you all doing that. We appreciate you as our clients and the trust you've put into us. And so with that, I hope you all have a great rest of the day, unless Jennifer, you have something else there.
No, I think you got it.
Okay. And if this will be on YouTube. Let's not forget that either. Let's let people know that too. Yes. So if your spouse missed it, we'll have that out by tomorrow. Is that fair?
Couple days. Give us a couple days.
It
takes a while to upload and download and format, so it does take just a little time.
Perfect. And again, if you want that article, it's very well thought out. And just let us know. Have a great rest of the day.
Perfect. Thank you.